So for us, obviously, following on from what Josh said, Josh has talked to us about the impact of how sort of the tax impacts what we can do. We're going to look at what we can do to impact our net profit and what we can take home. So the first port of call is to understand what you're currently earning, what you need to earn, where you need to go from there. So in order to calculate our break even, the first step is to work on our desired income. How much do you need to live on? This is your essential costs, and included within this, we include our sort of our luxury costs as well. So we're in this to earn some money out of it. What do you need to suffice the lifestyle that you want? From there, we then need to know how much of this needs to come from your business, from this business. So if you've got any rental income or any significant interest, how much of that can come from elsewhere? How much needs to come from this business? From there, we then look at how much tax you're paying on that income and how much you're net in your pocket to pay your bills. So, if we assume you need 65,000 in your pocket, that will mean you need 80,000 pounds worth of dividends in order to meet your bills as they come due. We have 80,000 pounds of dividends. Apologies at the back, hopefully the numbers are big enough. We've got 80,000 pounds of dividends at the bottom here. What that means is we need 80,000 pounds worth of net profit in order to pay those dividends out and have the retained earnings we need. From there, we can then look at the impact of tax. So we can calculate the tax that we're going to pay, work this backwards, to work out that we need to earn £107,000 to pay 27 in tax and see £80,000 of retained earnings to pay us our dividends. The next step from there is to look at our overheads. How much are you spending on office costs, rent, light, heat? How much are you spending on admin staff that you can't do without? Have you got any finance you need? Are you leveraged in any way? How do you go about financing your business? We add all of those together and we expect to get a relatively consistent cost month on month. This is what we would deem your overheads. In this case, we've assumed your overheads are £30,000 to run the business that you're currently running in its current state. That means we need a gross profit of £137,000 in order for the money to flow through, pay our tax, and end up with the £80,000 dividends we need to live on. We then look at our cost of sales and the margin we're making. The gross profit is sort of deemed the profit we're making after our variable costs and the costs we can directly attribute to our sales. So this might be your chargeable staff, your goods for resale, your materials you're buying, anything that's directly attributable to your sales. By selling more, you're going to spend more. We can look at this as your margin. In this case, we've assumed a 35% margin on your sales, but we need to look at if that's what you were expecting. Is that what you're getting? Is this the margin you're currently getting? What are you currently earning? And do you have a range of contracts that are perhaps at different rates? So if you've got different rates, we need to take an average gross profit margin in order to work out our turnover. From here, we can work it all the way back to see that we need £390,000 in order to see our gross profit, our net profit after tax of 80,000. Now, when you work those numbers, we can see that whether we're working on a monthly basis or a daily basis, perhaps this is £32,500 a month or 1,500 a day. You can then look at those KPIs and understand where your business is. Are you above or are you below? What days are working, what days aren't working? Now, if you've got a surplus, then that's great. If your turnover is greater than that, then that's great. You've got a surplus, you've got money to fall back on, you can leave those in the business. If you've got a shortfall, then you've got a number of options really. The first option is to reduce the bottom line, reduce your dividends and reduce your retained earnings. Hands up if you're willing to work as hard as you are working for less money. Yeah. So that's not really an option, let's be honest. So in that case, what we need to do is we need to increase our profit in order to see better dividends at the bottom. Now, there are 4 ways in which we can do this. The first 2 are slightly defensive. The first one being cut our overheads. So this is the most common that people see as the first option. they'll go out, we'll try and renegotiate our bank contracts, our phone contracts. And if you're spending 2 hours trying to find the right bank to go to, then spending another 2 hours of actually negotiating with that bank, going through their money laundering checks, you're probably going to save yourself £10 a month. It's £120 a year, which is £27 an hour. People want more than that. So if we look at the numbers, if you can save 5% cut in your overheads, that means you'll save £1,500, which is a lot of work to save that 5%. Now the impact of that is that you see £1,215 after tax. It's a 1.4% return on saving that 5% cut in overheads. Our second option is to negotiate suppliers. So rather than negotiating our overheads, we negotiate our suppliers in our cost of sales, or we look to improve our efficiencies. Can you get more out of the staff you've got? Can you get lower discounts on the things you're buying, bulk discounts, early payments? What can you negotiate? Again, still difficult, still has to be managed to ensure you're not losing service. But if we can save 5% on our negotiating suppliers, that means we're seeing about £13,000 increase in our gross profit. Once we run that through the numbers, you're seeing about £9,500 on your bottom line. Now, as Josh mentioned, whether you draw that or leave that in the business is entirely up to you, but it's nice to have that additional reserves there to fall back on should costs start to increase or should they start to change. The next two options are more offensive than they are defensive. So the first two mean that we're going out, we're cutting where we can, we're trying to save where we can. These next two mean we're pushing the business forward, we're trying to grow. So the first option is that we find new business. This is normally at the same margin, we're buying at the same margin, the same gross profit rate. We're trying to get more business through the door. You might have to invest in business development, you might have to invest in a sales team, but the impact is that we can move a £390,000 turnover to 410 just by attracting 5% more business. What that means on your bottom line is that actually attracting 5% more business means you see £5,000 more on the bottom line. So when you're working that margin, it's slightly diminishing your return on the investment of that 5%. The final option is that we optimise our pricing. So rather than just looking at getting new business, perhaps we look to increase our prices to our existing customers. Everyone seems to be apprehensive about this because obviously no one wants to actively raise prices to their customers. But what it effectively means is actually you're looking at the value that you're giving them and the value of the service you're providing. So are you providing more over and above what your competitors are? Does your price reflect that? If you can increase your prices, you might find some fall away, those price conscious customers, but actually you'll retain a better margin on the ones you've currently got. You hopefully will see a better return for that work you've done. So if we were to optimise our pricing, we simply increased our prices by 5%. Virgin Media recently just increased their prices by 8.8%, so this is still not out of the realms of possibility for most businesses, and they consistently do it and they're still growing. So having that increase in prices is not necessarily a bad thing. But what that means for your business is you see nearly £20,000 more on our gross profit line. We've increased our margin from 35% to 38%. Once that filters through, if you can maintain overheads, given the increase in turnover, you see almost £15,000 return on that investment, which is about 18%. So there's a significant benefit for being a bit bold. Now, to summarise all of those options, if we cut our overheads, saving 5% gives you 1.4%. Negotiating 5% on suppliers gives you 11.9% more profit. Turning over by 5% gives you 6.4%. And in optimising your pricing increasing pricing by 5% gives you 18% more profit. So these are your options really, but actually you don't have to do one of them, all of them, in order, out of order. You can work on whichever one is best for you and your business. Everyone's return on investment will be different through each of these different steps. So you could look to increase your pricing whilst negotiating with your suppliers and cutting your overheads. There's no set way of working your business, of getting the right answers. It's about what works for you in your business. If you've got chargeable members of staff, negotiating with your suppliers is going to be a lot more difficult. Asking which ones are willing to take a pay cut will be hard. But actually, working in your gross profit has a better return on your money than what actually simply just pushing new business or just working on overheads. So we're sort of going into a low inflation economy, and prices are still going up. National living wage has gone up by 10%. As I said, Virgin Media has gone up by 8.8%. So people's prices are still going up, and there will be a ripple effect, a domino effect of what happens to those prices, and your prices are likely still to come and increase. But actually there's still money to be made, and there's still profit to be made by being the brave and looking at your prices and optimising your prices yourselves.